Hello and welcome to this King Shaxson Asset Management fourth quarter review. My name is Will Arnold and I'm an Assistant Portfolio Manager here at King Shaxson Asset Management. I will be taking you through some of the drivers of a more positive quarter for portfolios, alongside some outlook as we head into 2024. The long-awaited interest rate pivot finally materialised this quarter, and as expected, this led to a significant rally across all asset classes, as can be seen by a global equity index on the left and a sterling corporate bond on the right. This also favoured investments with a stronger ESG and positive impact focus, a topic we recently covered in more detail and can be found on the news section of our website. The significance of this pivot in market thinking cannot be overstated. In a number of previous reports and written comments, the rationale behind this significance has been explained, and this remains largely intact. Towards the end of 2023, we saw interest rate cut expectations increase rapidly. The graph on the left shows what the market was pricing in for Fed cuts at the end of October 2023. As can be seen, at this point, around 3 cuts were priced in, taking the implied policy rate down to around 4.6% at the end of 2024. Fast forward to the end of December 2023, the market was pricing in around 7 cuts, taking the rate down to around 3.6% by the end of 2024. In the immediate term, we anticipate a cooling of these expectations, as central banks are expected to maintain a hawkish stance until an economic slowdown becomes more evident. The first week of January has seen this come to fruition, with yields back on the rise. That said, we expect this and any other cooling off to be short-lived as inflation continues to fall and economies slow. This is evident in the graph shown here, where the white line is UK CPI, the orange US and the blue Eurozone. Over the next 6 months, we expect interest rate cuts and, more importantly, rate cut expectations to increase. With interest rates no longer causing as much anxiety and uncertainty in the markets, the focus is capital discipline in a world where central banks are no longer flooding the markets with money or are in fact taking money out of the system. At the moment, cash levels are at a record high in money market funds. Over the year, we expect to see this level reduce as markets allocate to bond and equities. This time around, we expect a far more disciplined and selective approach by the markets, as cash will remain an alternative even at lower rates. We expect tapering to increase over the year, which has already begun in the US, as can be seen by the below graph of the Fed's balance sheet. The price of debt will be subject to other influences over the coming year. The level of both government and corporate debt is under the spotlight and has already caused some issues within the Eurozone and the US debt ceiling. In addition to tapering, there is a concern that governments have not been reining in their deficits fast enough in the post-COVID world, so while short-term interest rates may fall, investors may demand a higher premium for longer-term debt. This too may have a knock-on effect for corporate debt, as both uncertainty on the economy and the impact that higher interest rates have already had will increase the market's focus on quality. Thames Water provides a very public example of some of the issues faced by highly indebted companies. The politics of general elections, which are due in a number of major economies, will also impact government bond prices. In fact, around half of the world's population is expected to be going to the polls this year. Trump appears to be favourite to be heading back to the White House, giving his double-digit lead over Biden, although his removal from certain ballots is something that rumbles on. Modi is expected to return to power in India, whilst Labour have a firm lead over the Tories in the UK. Property, as shown on the left, and infrastructure on the right, have already benefited from the pivot in interest rate expectations. Further down the line, we expect to see some mergers of smaller funds and a gradual return of pipeline opportunities for these products. In the meantime, the higher income levels and upside opportunities remain compelling. The positive impact sector has also seen a strong recovery, reversing the negative trend that began in 2021. The solar and wind manufacturers and developers have seen a strong recovery in the last quarter, as have investments based around electrification. Whilst the pipelines have been strong for some time, it has taken the pivot in interest rate expectations to move the markets from an unhealthy focus on a very small number of global mega-cap stocks, known as the Magnificent Seven, to look at the opportunities in the wider market. The gaping performance differential between small and large companies has been narrowing since October. In the last 3 months of the year, the large cap index shown in the graph returned 6.24% versus 7.21% from small caps, and in the last month the large cap returned 3.72% versus 8.12% from the small cap. We still see some way to go as interest rate expectations allow the equity markets to broaden. Alongside the reversal from negative sectors such as oil and tobacco towards more positive sectors, the equity market performance of more impact-focused investments has also recovered sharply in both absolute and relative terms. Having been far more resilient than many expected, the global economic growth is now showing signs of slowing as a result of higher interest rates and less money in the system. At the same time, the multiple inflation shocks from COVID stimulus, supply chain issues, and the conflict in Ukraine have now worked through the economy, and the question that remains is whether we get a soft, hard, or even any landing in 2024. A great deal of the economic outlook depends on the extent of a general consumer slowdown and the continued transition to the new style economy. The economically important automobile sector is a pivotal example of this change, as Asian electric vehicles challenge US and European combustion engine vehicles in what is truly a global market, where China is the biggest player. This disruption threatens certain Western nations such as Germany, where the auto industry employs hundreds of thousands of people directly. We see growth shifting from personal consumption-based investments as the retailer drops away, to growth in providing solutions to global issues. This puts a renewed focus on electrification, which covers a range of industries, from transport to energy consumption. Global warming is already impacting food production, and changes in how we consume are required, but solutions in organic fertilizers, AI in watering and harvesting are seeking to get more from less and reduce the impact the food industry has on our natural resources. Other key issues we have previously touched on will continue to play out as important factors in the year ahead. Whilst 2023 was a positive year for renewable energy use, the commencement of new projects stalled in certain cases given inflationary pressures and supply chain issues. We expect a revived growth of renewable energy optimism as energy security matters, and the sector moves past the issues of the last 2 years. Positive noises came from COP28, with members attending committing to work together to triple the world's installed renewable energy capacity by 2030. This comes alongside legislation already in place, such as the Inflation Reduction Act and the REPower EU. Healthcare will also take on a renewed focus, broadening out from the euphoria of 2023's weight loss drugs to other medical advances, including medical technology, and we continue to monitor investments in this sector. Even with bumps in the road, our outlook going forward is more positive than before. Thank you for listening to this fourth quarter fund manager review, and we wish you all the best for 2024. If you have any questions, please contact your King Shaxson representative, who will be happy to help.